Joining us today, Mark Zandi, Moody's chief economist. Mark, happy Friday. It's great to see you again.
Hey, Carl, good to see you as well.
When you say keep the faith, is this sort of another way of saying don't talk yourself into a recession?
Yeah, I think that's another way of saying it. I mean, at the end of the day, a recession is a loss of faith, right? Consumers lose faith that they're going to hold on to their job, and they pull back on spending, run into the bunker. And it's a loss of faith by business people that they're going to be able to sell whatever it is that they produce. And if they feel like they can't, then they pull back, start laying off workers, and you get into a kind of a self-reinforcing cycle called a recession. So at the end of the day, a recession is a psychological phenomenon. It's a loss of faith.
Well, certainly UMich would not suggest that we're close, or would it?
Well, UMich is pretty, yeah, I mean, that says consumers are wavering. I mean, I do think my favorite measure of consumer sentiment is the Conference Board survey. It's a monthly survey that's been doing for a long time, more labor market based in terms of the questioning. And, that does a really good job of pegging when people when consumers lose faith. If that falls sharply over a couple, 3-month period, that means consumers are running into the bunkers. They're going to stop spending, and recession is at hand. It leads by about 6 months. But right now, by that measure, everything's fine. Consumers are hanging tough, and obviously, given today's data, they're out there spending.
But that's the thing, Mark. It's a very confusing world we're in, because the stronger the economic data, the harder the market thinks the economy will fall into a hard landing, because it means the Fed is just going to have to do more and stay higher for longer, and that increases the chance of recession. Yeah,
indeed, Sarah. Yeah, it's that needle, the thread, the Fed has to thread. Raise rates high enough, fast enough to quell growth and get inflation back in the bottle, and not too high, too fast to push the economy into recession. But given today's numbers, it feels like things are on the hot side. But I'll have to say, the month of January was just all juiced up. I think in part to the warm weather. Lots of jobs, retailing. You saw the service spending numbers, and of course that's translating into the higher inflation. It's not going to be a straight line. And I don't think it's going to be right back into the bottle for inflation. It's going to take some time, and there's going to be days like this when it's not going to feel all that great. But my forecast has not changed. I think inflation will get back to target by spring, summer of 2024 without a recession.
So that was my last question. You did not add a hike in June like a lot of the economic desks have. Why not? And would a 50 be dangerous at this point?
50 makes no sense to me, Carl. I mean, in the context of, the broad contours of the data, the economy is slowing. Wage growth is slowing. Inflation is slowing. It's moving in the right direction. And, I think the Fed's got interest rates pretty close to where they need to be to get things back down to inflation back down to target. A couple more rate hikes, March, May, makes sense, quarter point each. That's what's embedded in markets. Although today markets are starting, as you say, starting to discount a June rate hike. I don't think I'd argue with anybody, if they said, oh yeah, we're going to have a third rate hike in June. I don't think I'd argue with them. But in my outlook, I think a couple more rate hikes makes the most sense.